let's say if I have to have somebody file 1040, who is that person who's going to be filing form 1040? Is it, let's say, for example, I go to my sister's place in California and work for somebody for, let's say, 2 months. So I was on a vacation for 3 months and I work for somebody for 2 months. And I have no nationality. I'm not a US citizen. I do not have a green card. Am I required to file a US tax return, which is 1040? And am I supposed to pay taxes in the US? Or, for example, think about my sister. She's there in the US and now she has some accounts in India. She has a property in India. She has some investments in India and she's gaining and she's earning some returns out of those investments. Is she supposed to pay tax on those amounts also in the US? So before we start understanding what is 1040, we need to first understand who is supposed to be paying these taxes and who's supposed to be filing 1040. Okay, so I am there in the US and I'm making just very nominal amount of money. I'm supposed to pay taxes? Yes, no, I don't know. Right? So first, before we log on to what is 1040, we need to understand first who is supposed to file. Okay. So that's the first question that we're going to address today, which is who is supposed to file form 1040. And the second thing that we're going to do is for what income? Okay. Is it income in India? Is it income in the US? Is it all the income throughout the world? On what income am I supposed to pay taxes and what income I have to report in file form 1040? So that's the first thing that we're going to study today. And the next thing that we're going to talk about is, of course, the filing requirements. So who is supposed to file? That means once I determine the outer periphery, okay, so is my sister supposed to pay income tax on the worldwide income, only on the US source income? Is she supposed to file 1040 if she is not working in the US? All of these questions would be nationality. Filing requirements would be if I'm just making minimal amount of money in the US, can I avoid filing returns? So who are the people for whom it is mandatory? So considering that I have to file 1040, is it like the full gambit or is it a part that has to file form 1040? So we are going to talk a lot about when is the filing due date, who's supposed to be filing, what are the filing statuses, all of these questions we're going to talk about in today's session. Okay. So as I told you, basically we're going to split this into 2 sessions today and on Saturday. So today we're going to talk about just very rudimentary topics about, let's say if I'm filing my return for the first time, what is it that I'm supposed to be doing? What's my filing status? What's my filing requirement? So there are a number of topics. We're going to deal with these 2 topics in tomorrow's session. And in today's session, we're going to deal with the first 3 topics, which is what do I have to do if I'm generally filing my return and it's a continuous return? Then what are the preliminary work that I'm supposed to be doing? This will, of course, include nationality. And I'm also going to talk about the filing status. So everything to do with filing status, filing requirement, and nationality, we're going to talk about in today's session. So first of all, now generally, the first time when I'm filing my returns, I need to, kind of scrutinize the last year's return, figure out if there are any big changes. So if you look at it, even in India, when I file a return, and if it's an online return, I would probably just go and import all the data from the last time to see whether my basics are in place. What is the delta? So that somebody who's at the other end, and this is something that we're going to tie up with the part 3. So the moment I submit my data, what is it that the IRS does in the background to ensure that there is no tax evasion, there are no mathematical errors, and you have ensured completeness? So a lot of stuff people have to do when they're filing their return for the first time or when they have a continuous return. If it's a continuous return, we'll have to ensure that everything about prior year, we have an incremental approach to see that we're not missing out anything last year. Say, for instance, I've had certain deposits, I've had certain investments, and they look like continuous investments. Then is it suddenly that you've missed out on that particular return, or is it genuinely that you have discontinued those investments? So all of that is an incremental approach. A lot of data about, so when we go to 1040, you will see a lot of data about personal information will step in, like the dependents, who's the spouse, who's the taxpayer, who are the dependents, children. So generally, these are continuous things. If there is a child in the family, the child will grow. So continuously, that child would be a dependent. So the first job is the moment I fill up a return, generally we take the past history to see whether there is an incremental difference and if there's genuinely something that we have discontinued. All of this ensures that the return does not have mathematical errors. We know what's the change. So even when IRS does the scrutiny, they're going to take all of that into picture and then scrutinize. Okay, but this is typically theory, and I think you will be able to make a lot more sense of it when we actually go down to part 3, where we talk about the IRS side of things. So this is actually the first stuff that we're going to start with, which is nationality. Who is supposed to be filing returns in the US? Now, there are certain terms that we are going to be using in today's session, which are very important because even in future, when we are going to refer about the tax incidents, this concept will come into play. So be careful about the terms. So when I say who's a resident alien, who's a US citizen, who's a non-resident alien, you should be able to understand. So what we're trying to do is, think about that movie Godfather. So imagine there's a family which is like a Don's family. And we're trying to contemplate that there is a marriage proposal that's happening. We're trying to contemplate whether that person is good enough to come and stay with me. So there's a testing period. And after that, we finally execute the marriage and the person becomes a part of the family. Now think of it in terms of US. So first is if you are a US citizen, and I'm sure you guys must be aware that there's a whole plethora of stuff that has changed now when Trump has come into power this time, and he has scrapped the concept of US citizenship on the basis of simple birth. So earlier, maybe somebody has gone on vacation, not told anything to the authority, given birth to a child in the US, the child would be a US citizen. But effective February this year, the Trump government has said that no, in order for anybody to become a US citizen, if it's a child birth, either of the parents have to be either a US citizen or a green card holder. Unless and until either of the two conditions are met, the child will automatically not be a US citizen by birth. So the first thing is, if you're a US citizen, it's great because the moment you're a US citizen, you will not be termed as an alien for tax purposes. So the highest form of presence in the US is having a US citizenship. If you are a US citizen by anything, by any means, the moment either when you're born in the US and you meet certain criteria, or if you have been able to get a US citizenship later by adhering to the standards of the US laws, you are not termed as an alien. You're supposed to get something which is termed as a social security number, which is a unique identification number for every US citizen, and you're supposed to be paying taxes in the US. Simple. But what if you are not a US citizen? The moment you're not a US citizen, technically you would be termed as an alien for tax purposes. Now, this alien may be treated a little preferentially than a complete non-resident alien if this alien is able to satisfy either of the two tests. The first test is the green card test, and the next test is a substantial presence test. So technically, this alien will be split into two, a resident or a non-resident alien. A resident alien is somebody who's either following the green card test or the substantial presence test. What do you mean by that? So it is, think about that. You go to the US and you're US for a substantial number of days. So if you're in the US for a substantial number of days, and I've defined you what those numbers are, then I will treat you for the time being as a preferred member. So if you are a Don Corleone and if you are allowing somebody to be a part of your family, you let that person come and stay with you for some time. So substantially that person is present in your family and I've given you the rules, then I'm going to call you a preferred member, a resident alien, somebody who's not a US citizen, but on the US soil has been present for a phenomenal number of days, which makes it important for that person to pay taxes in the US. Or there's a valid immigration certificate where the US formally recognizes you as a valid immigrant and issues you a green card. So it's like the test period before they will make you the final citizen. So before that spouse or before that marriage prospect finally gets married and gets into the Don's family, we give them a card and say, okay, now I think you are deserving that possession. So that's a green card. So either when you get a green card or you're substantially present in the US, you're technically termed as a resident alien. But if you are neither, so neither you're a US citizen, so you are now an alien, and you neither satisfy a green card test nor you are substantially present in the US for the significant number of days, then I ask you, did you leave or come to US this year? Why? Because in case if this is the first year in which you have entered or left US, then you get a dual status alien, which is for part of the year you may be a resident alien, for part of the year you may be a non-resident alien. But that's an exception. generally you would be termed as a non-resident alien. So a resident or a non-resident alien would not have something called an SSN. They will have something called an ITIN. So social security number is issued only to US citizens, but if you are an alien or a non-resident alien, you need to have an identification number called the ITIN number, which is individual tax identification number. You use that number and then you go and file your returns in the US. Now, one thing which is very important is the moment I say you're a US citizen or if you are a resident alien. So it's either US citizen or a resident alien. You will have to pay tax on the income that you have generated worldwide. That means it doesn't matter whether I've given you a US citizenship, even if you're a resident alien, you would have to go worldwide and whatever money you have earned, you will have to pay tax on the US soil. So going back to my example, if my sister who's a US citizen is supposed to be having investments elsewhere in the world, let's say in India, so she is supposed to report that income in the US and then pay taxes. Now, does it mean that there would be double taxes? No. Most countries have treaties that have signed. There are departments, if you look at it in big fours like transfer pricing, where there has been situations where most countries want to avoid double taxation and they have signed treaties. But technically, under the IRC code, which is Internal Revenue Code, you're supposed to pay tax in the US. So you will see that there are credits available even in filing Form 1040. And when you go further up, you will see that there are treaties which determine which portion of tax can be. So countries have decided who will have the tax incidence for which portion of the income that is being generated. Now, if you are neither a US citizen or a resident alien, that means if you're a purely non-resident alien. So I went on a vacation for 3 months and I earned in the US. Now, only if I earned in the US am I supposed to file Form 1040 because I have to report US source income in the US. So if I go on a vacation, I neither have a green card nor I have a substantial presence in the US, neither am a US citizen. But I'm earning in US dollars while working in the US for 2 months. I will have to file Form 1040 and pay tax in the US. Now, see, there is one exception, which is a very unique exception. It says what? Let's say there's somebody who gets married and moves to the US, and that happens in the middle of the year. Now, when this person gets married, the spouse is a US citizen. And the spouse wants to file something called a married filing jointly return. Now, again, that's a unique concept in the US because in India, every individual has to file their own return. So, me and my husband, we cannot file one return. There would be two returns which would go, one for me and one for him. In the US, there is an economic advantage of getting married. So they tell you in case if you're married and if you prefer to file a joint return, you will have tax savings because you'll have to pay less taxes. So now imagine a scenario where the US citizen or a resident alien who's reporting worldwide income gets married to somebody who's moving to US for the first time. And now this person is a non-resident alien, right? Generally, because neither of the tests have been met. But there is an exception which says that this person can file certain forms and tell the IRS that I choose to file Form 1040 with my husband and I want, or with my spouse, and I want to file MFJ return. In that case, for the entire year, the person will be treated as a resident alien along with the husband and along with the spouse, and that person would be taxed on worldwide income. So that's the only exception for a person who's marrying and going to the US for the first year. So if a non-resident elects to be treated as a US resident, why? For example, to file married filing joining return, in that case, you would be taxed on worldwide income. So for the entire year, you will be treated as a resident alien, just like, you will not be treated as a non-resident alien. So to sum up, three things: US citizen, you get an SSN, file return, and report worldwide income. If not a US citizen, you have to either be in the US for a substantial number of days or you have to satisfy the green card test in order to be called a resident alien. You report worldwide income and then you pay tax on it in the US. For a resident alien, you obtain the ITIN number. If you have neither the US citizenship, nor you have the green card, nor you were substantially present in the US, technically you will be termed as a non-resident alien, and you will have to report and file return only for the income that you've generated on the US soil or US soil. The only exception is the person who's moving to US for the first time after getting married to a spouse who's already a resident alien or a US citizen. In that case, the choice is given to that person. And if that person chooses to file a MFJ with the spouse, then the filing status for that person would be a resident alien, and even that person's worldwide income would be reported in the US. Simple. So then comes the question, what is a substantial presence test? What is a substantial presence test? It's a very simple test. It says that for the year in which you are determining, and this changes every year because you may be present in the US for different number of years for different years. So in the current year, you must be there in the US for at least 31 days. And if I look at the 3 years, that means this year, last year, and the year before that. So this is current year, this is current year -1, and this is current year -2. So what I did, I decreased the weightages of the number of days that you've stayed. In other words, in the year 2 years before the current year, I'm going to count 6 days as 1 day. And in the last year, I'm going to count 3 days and 1 day. And in the current year, I'm going to say that every single day is equal to 1 day. So I'm going to have different weightages for the 3 years, current year, last year, the year before that. And it has to add up to at least 183. So if both the conditions are met, that in the current year, I was there in the US for at least 31 days, and in the last 2 years, along with the current year, I was there in the US for at least 183 days. If both the criteria are met, then it is called that I have met the substantial presence test. Now look at this question and tell me whether this person has met the substantial presence test. So you're physically present in the US for 120 days. So for 4 months typically, in each of the years, 2000, years 1, 2, and 3. You're supposed to figure out that for the year 3, are you satisfying the substantial presence test? Can you please put your answers in the chat panel? Yes, no, and just give me the number of years that you're getting for substantial presence test. Now see, this is met, right? Because the current year, it is 120 days. What about the 2 years before that? It's not, what's the number of days that you're getting? No? Yes. The total is 180 days. How? For the current year, you will take 120. For the year before the current year, you will take 120 into 1/3, which is 40 days. And for the year, which is the year before the last year also, I will take 6 days as 1 day, so it comes to 20 days. So I'll add it up to 180 days, which is less than 183 days. So substantial presence test is not satisfied. My sincere suggestion, don't rush to the questions. You'll have enough time. I've never seen anybody complain that they were not able to complete the paper. Okay, but go slow. See to it that you don't make calculation errors. Okay, so it's a very simple concept. Who's supposed to be filing which return? So 1040, and under what circumstances? Polumi, I did not get an answer from you. Please try to answer the questions. So because see, I have chosen some very good questions, and the objective of those questions is to make you understand every provision practically. So if you're able to, even if you make a mistake, then if you understand what is happening, then with whatever questions we are doing, please understand that you've understood the provisions really well. So keep this learning active learning. So that was the first concept that we did today. There are a couple of things that you have to understand. If I'm earning any kind of wages in the US, it is termed as income that is connected on the US soil, and I have to pay tax on it if I'm a non-resident alien traveling to the US and earning wages. So for 2 months, if I did internship somewhere and I got money, it is wages and I will have to pay tax in the US. Most type of US source income, which is received by foreign taxpayers, they are subject to tax rate of 30%. This I told you that if the non-resident alien who has been married and going to the US, for the entire year, that person will be considered as a resident alien, and that entire year, whatever money. So even if the marriage took place, let's say in November, and the spouse goes and starts staying in the US, the spouse's entire year's income would be reported in Form 1040 as married filing jointly coupled. Okay. Now, this says that, see, once, so this is again related to this point, which says, let's say if the couple is married and they're filing a resident alien status. So generally you will see that first 3 years a resident alien concept will not be met, right? Because the substantial presence test will not be met. Of course, the green card will not be issued immediately after the person moves in. So there is a gap of 2.5 years till the time you can get a resident alien status generally. Okay, so for these years, the person who's a non-resident alien will choose to file as an MFJ. But for this year, if anything happens by which the IRS feels that you don't deserve that status can be revoked. So there are three things by which the status can be revoked. First is if that relationship ceases. So if the spouse dies, if the spouse is having a divorce, in that case, a question of a resident alien status does not come. And secondly, if IRS feels that you've not been able to keep adequate records to substantiate your claim, in that case also the resident alien status for a person who chose to be treated as a resident alien by virtue of filing MFJ returns with the spouse, that will be revoked. So this completes the first topic completely. There is another thing that's related to this concept, which is, so you remember I spoke about my sister who's in the US, right? Now, let's say if she has a bank account in India. Okay. Now, even if, filing of the return is one thing, but in order to monitor the inclusion and the fraud and all of that, there are certain reporting requirements that needs to be met if somebody has assets or bank accounts outside the US. So there are two reports. What is important is that you might be required to figure out when do you have to file these reports and does these reports go and accompany the financial returns or not. So the first report is called the FinCEN Report 1. Very colloquially, we call it a FBAR report, Foreign Bank and Financial Accounts Report. Okay. Now, what is this report? This report generally comes into picture if either a US citizen or a resident. So now when I use the term NRA, resident alien, US citizen, you should be able to understand those terms. So if either the US citizen, resident, or a person who's doing business in the US has ownership interest in authority. So basically, if I have a financial account in another bank, so I have a bank account, I have an investment account. If any of these financial accounts are being held by me, whose value at any time during the year touches $10,000. For instance, I open a bank account in India, I put in 3,000, and then I get some interest, and then at 3,000 becomes, let's say, I put in another 8,000. So what happened in the month of January, I put in 3,000. In the month of, let's say, April, I put in another 8,000. And then in the month of November, in the month of November, I withdrew, let's say this is 11, I withdrew $1,000. So I'm ending the year with $6,000. Now, what is important is not the balance on 31st December. What is important is throughout the year, did at any point of time the balance in your foreign accounts touched $10,000 or not? The moment it touched $10,000 and it increased, so it has to be 10,001. The moment it does that, then you need to report this account in the FinCEN Report 1. So please remember, this is restricted only in case if you have a foreign bank account and if you are supposed to be filing returns in the US on worldwide income. Why do we do this? Because we want to make sure that you are actually reporting income from these accounts in the US return. So this is a kind of a measure by which that reporting obligation is put on the US citizens or residents or people who are doing business in the US who are supposed to be paying tax on the US source income. When is the due date? The due date is the same as that of the return. And this is something that we will learn in today's session, that the due date for filing the return is April 15, but it can be extended to October 15. The same provisions are applicable for the FinCEN report. If let's say you have not disclosed it and IRS have discovered that there was a requirement that you've not met, please remember there could be criminal penalties that could be imposed on you. So civil is you can be fined. Criminal is you can be put behind the bars. And where do you file this report? This report is filed online with Financial Crimes Enforcement Network. So one is very clear, at any point of time, if you have a foreign bank account or a financial account. Financial account means investments, demat, all of that. In that case, the moment during the year it touches 10,000, and it doesn't matter whether at the end of the year the balance may become $3, you never know. But even if during any part of the year it had touched a figure which crossed 10,000, you will have to report it. And please remember that there are criminal penalties involved. There is another report on the other, which is something which accompanies your income tax return. So when you file your 1040, you will have to file Form 89 with it. And this form is supposed to be filed for individuals who are living in the US to report what? To report a foreign financial asset. So remember, this is a bigger account, because here these assets may be your any kind of an asset. Okay, it can be your jewelry which is kept in the bank account in India, or it could be your property which is there in India, right? So it's not just limited to bank account, it is a bigger subset. So FPAR is a subset of a bigger one, which is Form 8938. And when are you supposed to file Form 8938? You're supposed to file that form when the aggregate value of all of those assets exceed either 50,000 at the last day of the year, or it touches 75,000 at any time during the year. I think this is easy to understand. These are individual thresholds. The moment you go to married filing jointly coupled, the thresholds will increase. Since it's filed with the US tax return, you have to abide by the due dates of a US individual tax return, which is April 15, or if filing extensions are sought, 6 months automatic extension and becomes October 15. And this also means that in case if I'm not obligated to file 1040, I will also not be obligated to file Form 938, because this is add-on to your Form 1040. So if the requirement of 1040 is not there, even the requirement of Form 8 will not be there. It's a small area, but it's an area where you can get 1 or 2 MCQs, so just be careful. The only key term that I want you to understand here is at any time. These are simple questions, but the way you should be answering an MCQ for any US based exam is, don't try to choose the right answer. So see, generally out of any 4 options, you will see 2 of the options you will be able to negate immediately. The balance 2 option, negate the wrong option and let the 4th option remain. So don't try to pick out the right answer. Try to eliminate the 3 wrong answers. 2 will automatically come to you. From the balance 2, eliminate the second last option and let the correct answer remain. So let's look at this question. Now, how should you be reading the questions in the MCQ? Ideally, so this is a simple 1-line question, but always first read the last line of the question to know what's the ask of the question. Then go to the question, read the full question, eliminate 2 answer choices straight away. Out of the balance 2, eliminate the second last option and let the last option remain. So which of the following is true regarding the report of foreign bank and financial? We are talking about the FinCEN report. Okay, please give me your answers in the chat panel. The way you need to answer is you have to write 1 and then give me the option A, B, C or D. 1 and then give me the option A, B, C and D. So which is true? The keyword is true. In your mind, when you read the question, try to pick up the keyword. So MCQ, read the ask of the question first, read the full question, keep the keywords in your mind, eliminate the 2 answer choices immediately. Then out of the balance 2 which are remaining, eliminate the second last one and then pick up the last one. So which is true? The FinCEN Form 114 must be filed by anyone with financial interest in or signatory authority over a foreign bank account. This is wrong. Why? Because we know it's not anyone. If my thresholds do not cross 10,000 in a year, I don't have to file this form. So I know this is not the correct answer. The due date is July 15. Even I know this is not the right answer because the due date is April 15 or October 15 in case if extensions are sought. This is wrong because only it has to be greater than $10,000 at any time of the year. The FinCEN form is filed with the current tax year individual income tax return. Now this is incorrect because you file it, the due date remains the same, but you file it online with the crimes network. So this is the correct answer. So I know this and this is straight away wrong. Out of these 2, I know this is wrong. So this remains as the right answer. The questions are going to be, so this is a straightforward question. If you know the provisions, you will be able to answer this question. Take another question. Go slow and then give me the answer to this question. When e-filing their federal return, please give me the question number and then the answer. Okay, don't rush. It's not relevant. I'll give you enough time to solve all the questions. Please give me 2 and then the answer because I wouldn't know whether you've been answering for the first question or the second question. Please write the question number and then the answer choice. When e-filing their federal return, a taxpayer who meets the requirements to file both the forms should do what? Give me the answer for the second one. Attach both forms to the federal return. This is wrong because I know I need to attach only Form 89 to the federal return. attach only the form 8938 to their federal return, and then file the form 114 through the Financial Crimes Network. Now, this appears to be true, but we'll check the other two. Remember, never answer a question by simply reading. You get the right answer and then you don't read the other two options. Never do that. Always read all the four answer choices, even if you're 100% sure of what is the right answer. Attach only the form 114 to the federal return. This is wrong because it is attach only 8938 to the federal return. Send both the forms in separately. No, you're not supposed to send anything to the IRS separately. So I know that the answer is 2B. You have to be 100% sure of why you are answering a question. You don't have to rush through and see if you feel, okay, 2 can be right, 3 can also be right, then it will be an issue. Guys, just give me a moment. Yes, sir. Sorry, guys. Huh? Okay. So this is the first concept that we just completed, okay, which is nationality, who's supposed to be filing which form, and the two requirements that needs to be filed by people, US citizens or resident aliens. Now go slow and answer this question to me. What is the amount to be included in J's? Okay, another shortcut I'm telling you. Don't read the full name, it's useless. Just write A, B, C, something like that. So what we did, we first reading the call of the question. What is the amount to be included in J's gross income on his form 1040 NR? So NR is non-resident. So if you're a non-resident, you're supposed to be filing form 1040 NR. So J is a citizen and a resident. Don't rush to give me the answer. Go slow and then give me the answer. J, a citizen and a resident of Canada. Canada, that means not US, is a professional hockey player with the US hockey team. Under Jay's contract, he received $68,500. What's happening is a person who's not a US citizen, but that person is coming to US and playing in a club. And they have a contract where the work has to be for 165 days. Of the 165 days, 1 was spent performing services in the United States and the balance playing hockey in Canada. Now tell me what portion of income would be taxable in the US. Go slow, guys. There is no marks for finishing the paper earlier than whatever number of hours you're talking about. Go slow. So what does the law say? So whenever you get a question, in your mind trying to go and figure out what the law says. Law says, if you are not, so this person is a non-resident alien, clearly, right? Why? Because this person we have no idea when this person was substantially present in the US because it's only the current year's data that is given to them. Another rule, don't assume anything in the examination. So don't assume anything. That's another very important area to crack the MCQs. So we have no idea about US citizenship, resident alien. So I know it's a non-resident alien. What does law say? Law says if you're a non-resident alien, you will pay tax on the income that you generated on the US soil. So in this case, total $68,500. But out of this, you worked in the US for only 132 days. That means the balance is not in relation to income generated in the US. The balance is the income generated outside the US. So find out this proportion and that amount. So how much is this? I think this is 54. So the answer becomes D, which is $54,800. Okay, I go to the next question. If you have anybody who's not able to understand, please raise your hand. Please write your query. So if it's a technical question that we're doing, please stop me when the question is finishing. Don't go towards the end and then tell me there was a problem with this question. Okay, last question before we move on to the next concept. 1 second. Yeah, but why 183 days, Sakshi? Unmute yourself. Why will you do that?
It's only he was not the resident of US, so don't we have to check for the 183 days?
But you don't have data about the last 2 years, no?
Yes, ma'am.
Then why will you check how will you check 183? You are assuming, again, see, you are assuming that maybe he was a resident, but that data is not given. It's only the current year's data that is given to you. So why will you go to the last 2 years test? The data is not there in the question. Is that clear? See, the requirement. So why is that data relevant? Whether it is 68,500 or whether it is 54,800, that has to be met. Yes or no?
Yes, ma'am.
But why will you go to that? Because very clearly this person is a non-resident alien, isn't it?
Yes, ma'am.
So you will not go to 183 days test, no?
Okay, he is a non-resident alien. If only he has been a resident alien, then we have to check for resident. Yeah, okay, ma'am.
Oh, okay, listen. If you have to determine whether that person is a resident alien, then you have to go to substantial presence test, right? But we don't have last
Yes,
2 years data, so that means clearly this person is a non-resident alien. Is it
okay,
okay?
ma'am.
So
Yes,
the
ma'am.
starting point is NRA. Then comes the rule that if it's an NRA, then you have to pay tax only on the income generated for US related trade and business. That is why I'm applying this rule and answering the question. Okay?
And if in this question it was mentioned that only he came to US this year only, if this line has been mentioned, then we have to go for that test, right, ma'am?
No, why? In this question, we are assuming he has come to US for this year only. Please understand, this guy, they have not given you anything about the last 2 years. What does the substantial present test rule says? The substantial present test rule says that this year has to be 31 days and this year plus last 2 years has to be some other number of days. You don't know
Yes.
this data, so we'll assume this to be zero, right?
Yes, ma'am.
So then how is this test going to be relevant? You will never be
Okay.
able to satisfy this because you have only current year data. You don't have the last 2 years data.
So we are only paying on the portion of US income now.
So only in case of the current year, so you are saying what if in the current year itself it is 183 days? Is that your question?
Yes, ma'am.
Is that your question?
No, ma'am. I actually assumed that he was he was not there in 22 and 21 last 2 years. So I assumed that he was not there. So I calculated it as zero. But as the data was
It's
not
true.
there,
But that is true. That is true. He was not there for the last 2 years. You don't know whether he was there. So we'll assume he was not there.
so okay, we will not assume that he was there or not. So we will
See,
just put,
okay. No, no, listen to me. If this data would have been more than 180, then I would
yes,
have
ma'am.
taxed 68,500 because in this case, in the current year itself, that rule has been met, right?
Yes,
The
ma'am.
total 183, the person, if they would have told you that in the current year, this guy was there for 185 days, then
Yes, ma'am.
automatically I know this is met and this is met. Then that person is
Yes,
a
ma'am.
resident alien. Have you
Yes,
understood?
ma'am.
If
Yes,
it
ma'am.
is less than 183 and you don't have any data about the last 2 years, that means
Yes, ma'am.
automatically this condition is not met.
Yes, ma'am.
So your assumption that he was not there in 2002 and the earlier 2 years is correct, right?
Yes, ma'am.
So, but this will automatically not be met because this year's data is less than 180. So if this year he was only there for 160, so it's not only 165, it is less than 165 in fact, because the balance 33 days he was outside the US. So the other
Yes,
two
ma'am.
are zero. So obviously this will not be met. This is not met. So you know the answer is 58. He's a non-resident age. Is that clear?
Okay, ma'am.
Yeah. Okay, last question before we move on to the next topic. Okay, read the question slowly and then give me the answer. Which of the following statements is true regarding US taxes? Mr. H is a foreign student studying for a degree in the United States. There's a student who is a foreign student gone to the US to study. There is no income tax treaty between his country and the United States during the 9 months of the school year. So he was there for 9 months. Mr. H is employed part-time by a corporation incorporated in his home country, doing business in the United States. So what I did, I was associated with a company in India. I went to the US and I was still associated with that company. I was working in the US for that company. During summer vacation, I came back home where I was employed by the same company. You're supposed to tell me what is true regarding the taxes that you have to pay in the US. Give me the answer for question number 4. Give me 4, A, B, C, or D. Yes, go slow. Try to get at the right answer. So first tell me what is his residence status. Now you know he's not a US citizen. You know because the answer would be based on the theory. What the theory says whether he's a resident alien or a non-resident alien. So this is the first year this guy has gone. So I know this, and this year he is not. He's been back to his hometown also, right? Okay. So this is he becomes a resident alien because in the current year he was there for at least 31 days, and in the if I look at the number of days for the last 3 years, including the current year, it is more than 183 days, right? So then he becomes a resident alien and he'll have to pay income throughout the money that he's generated in the world. This is clear. Let's go to the next concept, which is the filing status. Now, this is an important concept because this is something which is very different from our country to what happens in the US, right? In India, as I told you, every individual has to file their own return. Nobody is filing the return as a joint couple. But in the US, there is an economic incentive for getting married and you have an option. So there are a couple of, so even within individuals, there are 5 categories that you can use. So remember, there are 5 categories, but there are 3 tax slabs. There are 3 tax slabs. So what are these tax slabs? We have single. So what do you mean by this? We have 5 categories but 3 different tax slabs. Before I go there, I want to show you. Okay, let me first discuss this. Then what we'll do is I'll show you the actual tax slabs to figure out which one is most beneficial and which isn't. So we have single. Now, single and married filing jointly, we understand. But what about married filing separately? What is this head of household and what is this qualifying surviving spouse? So, even as an individual, you have 5 different marital statuses or 5 different statuses which will give you economic advantage or which may not give you as much economic advantage depending on which status you are choosing. And this is something which can change year on year. So every year when you file your return, you'll have to determine which is your status. So what are these 5 statuses? Now, first, let's understand single versus married filing jointly. The first thing I want you to be very clear is birth and death are not prorated in the US. Now, what do you mean by this statement? If somebody is born, so US has calendar year end, okay? That's you have to understand that US has calendar year end, which means what? Any person who's filing returns in the US has to report the income from January to December. India has fiscal year end. We take 1st April to 31st of March. In the US, it's calendar year. So irrespective of whether a child is born on 1st January or on, let's say, 30th of December, that child would be written as a US. So if I'm taking dependency exemption for that child, or if I'm taking any credits for the child, I'll do it for the full year. Let's say if you're married on 30th of November, I will still get the benefit for the entire year. You will not prorate it saying that for say 11 months I was single and for 1 month I am married filing joint. You would not do that. Okay. So please understand that we don't prorate birth or death. So what are these returns and how is it applicable to us? First of all, the fact whether you're going to be filing as a married filing jointly couple or you're going to be filing as single depends on single day. So in the US, there's this concept of getting married in LA. So imagine people go out to celebrate the New Year celebration in the US. Last year of the year before the clock strikes 12, they're married. So if that happens, they will still be allowed to file a married filing jointly return, even though for 364 days and let's say 23 hours you were single. It doesn't matter. On 31st of December, when the clock strikes 12 on legal paper, are you married? If yes, you will get to file a married filing jointly return. So on the last day of the year, are you legally married? If yes, if you're staying with your spouse and whether you're alive or dead for the whole year. I'll tell you why is this relevant. Just hang on for a moment. Sounds very creepy at this point of time, but it doesn't matter whether that person is dead or alive. The remaining person, the person who remains, or so generally if a married couple is there, they would be filing a joint return. Even if between the spouses, one spouse dies during the year, and if that person would have been alive, they would have filed a married filing joining return. Still, the couple or the person who's a surviving spouse will go and file a married filing jointly return. So if you're married, or if you would have still went ahead and filed a married return in case even if the spouse dies, then the return which is supposed to be filed will have married filing jointly status. If you're not married, then of course you're single and you will be using the single tax slabs for the US return. If you're married but you're not staying together, then the question that comes is on paper, is your divorce through? So if you're married but you're legally separated, then also you're going to file a single return. Okay. But if you're married but you're not legally separated, then you will not file a single return. You will still be allowed to file a joint return. So single thing is very simple. If you're married on the last day of the year, you file a married filing jointly return. If you're legally separated or if you're not married, you will file a single return. Even if one spouse dies, the remaining spouse in the year of death can take the married filing jointly return. So you will see that in order to prevent certain hardships, there are some filing statuses that can be assumed or some filing status can be taken just to ensure that some unnecessary hardships can be avoided. So we will see what it means by being a qualifying surviving spouse. But at the moment, remember, in the year of death, the surviving spouse files a married filing jointly return. Now, there are two things that I want you to remember here. One is, okay, If it's a married filing jointly return, please remember same-sex marriages are also legalized in the US, and you can file a married filing jointly return if it's a same-sex marriage. Second, both the parties, the moment you file a joint return, both the parties become jointly and severally liable for the joint liability of both of them. That means, unfortunately, let's say if you're married to a person who had a huge debt to IRS in the earlier years, you were not aware, but you got married to that person. Will you be liable to undergo and pay the debt? The answer is yes. Then even your income can be attached to pay the debts of the spouse who was for which you do not know. So please remember, the moment you're married and you're filing a married filing jointly return, you undertake the liability of both the parties. So be very careful before you file a married filing jointly return. You need to know whether the person you're marrying is not having any past debts, because your income can be applied to recover those past debts. Now, in certain cases where there can be a fraud, you will see that there are certain relief that is given to the spouses. So generally, what happens if you're a married filing jointly return, everything has to be paid together. But in certain cases, if you're duped, how? We'll talk about it. So two scenarios. There is a separate paperwork where you can say, let's say I was not aware, or I'm an injured spouse. So there's something called innocent spouse relief and injured spouse relief. In both the cases, the spouse whose relief will be granted will not be liable for the spouse's share of problems. So what are the conditions which differ between injured and innocent spouses, and when can you take this relief? The one that I just told you, the couple got married, but this marriage happened because of trickery. Why? Because there was a guy who was in debts. He got married to a girl, let's say, who's really rich. And the idea was to dupe her into marriage so that a lot of my past debts can be settled. Now, in this case, the person who was not aware of the past debts can claim from the IRS that I'm an injured spouse. I was not aware that this was a scenario, and I don't want my income now to be attached to repay his, this debt. If that happens and if the IRS agrees, then what you get is an injured spouse relief. When that happens, you would not be. So, in that case, what has happened? All the income has been used to settle the past IRS debts. And now you can claim a refund saying, see, you've already used my money to pay that person's debt. I was not aware of it. So please give me back my money. So that refund can be possible if the IRS accepts your injured spouse plea. So what do you have to do? You have to file Form 8. And definitely you should have been filing a married filing jointly return in order to claim the injured spouse relief. What about innocent spouse relief? Innocent is when there is a crime that has been conducted, and now you are saying that you are not a party to that crime. So what happens? There is an understatement of tax. Now, when you go to, let's say, part 3, so you will have to, refer to part 3 for this. Okay. So please refer part 3 for this. So when you go to part 3, you will see that if, let's say, for any year, I short pay my taxes, then I'm supposed to be liable to the IRS. So now this is what is happening. There is an understatement of tax. So what happened? I married a person, and that person was unethical. So what he did, he claimed a lot of deductions. He claimed a lot of income. So there were income that he was generating, and he did not report it. So in all of those cases, there was an understatement. But the fault was not mine. The fault was of that person. And if I can prove it to the IRS that, see, this penalty should not be applicable to me because I'm not a party to it, I was duped into it, and I was not aware of it, and I can substantiate it, then the IRS can give me an innocent spouse relief and not ask me to pay the penalty for the understatement. Okay, so the first thing very clearly is, remember, injured is when your money was utilized for paying the past debt of somebody. So you got injured because you lost your money, and now you're applying to get the refund. Innocent is you have underpaid the taxes, there's a liability, and now you're claiming the IRS to absolve you of that liability. So one is a refund, another is a payment. Okay. So in this case, either when I know I've discovered that the person that I've married to is a criminal and I want a divorce. So when I'm in that state and I can prove that we are in the process of getting separated, I can tell the IRS that whatever is the understatement is his understatement, don't get me involved in the process. Okay. And anyways, if I can substantiate that whatever has happened is not my fault, is the fault of the spouse, then in that case, there can be a separation of liability. So in this case, the IRS can split and say, okay, your part, you are responsible. her part, she is responsible. There's a separate form for this. That form has to be filed. So remember, again, what are we studying? Single versus married filing jointly return. Who is single? Single person means I'm not married, legally separated, single. Married filing jointly, last of the year, you're married. In that case, it's a married filing jointly return. Even if one of the spouses dies, in the year of death, it is married filing jointly. The exception is generally whenever you're married, you will get to file for joint returns and you are jointly responsible for all the liabilities. But there are two scenarios where you can claim either an injured spouse relief and claim refund for the money or an innocent spouse relief. Okay, so this is as far as married filing jointly, single are concerned. Now we go to the next topic. What happens if you're married filing separately? So you're using the joint tax rate. So you're using the joint tax rate, which is the best and the most effective rates in the US, but you're splitting it into two. So two people who are married, but they're saying the IRS that I am married, but I am not attaching my name with that person's name. Okay? So think about a scenario when the spouse is getting married for the first time and the spouse needs to be very clear that I don't want to be attached with your return because I don't really know your background. And just to be sure, both the people agree that for the next couple of years, they're going to be filing separately. Is that allowed? The answer is yes. Or let's say if I know that my spouse is an antisocial person, and even though I'm married to that person, I don't want my financial records to be messed up with his financial records. So I can file a married filing separately return. But the biggest problem with this return is that IRS wouldn't want you to do that because in that case, the entire purpose of creating a married filing jointly incentive gets defeated. So yes, they've kept the option of married filing separately, but they've made it very clear that don't use this option. How do I do that? I say I pull down a lot of credits, a lot of advantages that I give to married filing jointly if you are married filing separately. So it is an option available, but there are a lot of disadvantages. There you don't get to earn certain credits, which may be child. And so when you go to the credit portion, you will see you will not be able to earn all of these credits. You will see for the others, maybe you have to earn more amount to file your return. If you're a married filing separately couple, you'll have to file your return the moment you earn $5 as your income. So we have made it very harsh for the taxpayers to report his married filing separately. We have made it economically very difficult for them. So we have given you this option just to keep your name aloof from the spouse whom you think may not be the right guy or the right girl. But we have asked you specifically not to use it. It's in extreme rare circumstances that we use it. How? By pulling away all the benefits that I'm giving if you are a married filing jointly. Okay, now there are two more statuses. Remember, status and tax rates are different. Why? Because you already know that for married filing separately, I don't need a separate rate. I will just take the married filing jointly rates and I will divide it by 2. Now, there are two more statuses that are available in order to avoid undue hardship. Now, what do you mean by that? Imagine a scenario where A is married to B. A dies. B, so A was earning more. And the breadwinner of the family dies. B was earning significantly less. And they had a child, let's say, who was an 8-year-old child. Now, what is happening? Suddenly, B has a financial burden to keep the house rolling, to keep the child studying, and all of that. But at the same time, if B would not, so we know that in the year of death, not an issue, we know in the year of death, B will pay less taxes because B will file a married filing jointly return. But what will happen subsequently? Because we cannot suddenly jump in and start working, right? So in order to avoid undue hardship, for 2 years following the date of death, that means in the year of death, I give you the advantage. And for 2 years following the year of death, if you can substantiate that you have a child or a dependent whose money you are paying and for whom you're maintaining the house, then I will let use the benefits of married filing jointly rates. So what is a qualifying surviving spouse? You are a person whose spouse has died and you have a child who's dependent on you. So both the conditions have to be met. You must have a spouse who died and you have a child who's dependent on you. In that case, please remember it is not applicable in the year of death. So not applicable in the year of death because In the year of death, you are going to file a married filing jointly return. But for 2 years thereafter, for 2 years subsequent to the year of death, if you have a dependent child, you can use married filing jointly rates. So you will see that there is something called married. So the rates are different, most economical for married filing jointly. So just to prevent undue hardship, I just don't want to increase your tax burden because you have a dependent child and you lost your spouse. For 2 years subsequent to the year of death, if you have a dependent child, you can say that your status is qualifying surviving spouse and you can take advantage of married filing jointly rate. So see what we did? We did single, we did married filing jointly. Now we don't need a slab for married filing separately because it is half of married filing jointly. We also don't need a slab for qualifying surviving spouse because the rates used will be married filing jointly rates. Okay. So first thing is, please remember that you must maintain your house for the whole year. So if you're wanting to claim a qualifying surviving spouse status for the entire year, you will have to claim that the child was your child who's dependent on you. And how would you prove that? Because you've maintained your house, which for the entire year was a principal place of residence for your dependent child. Now, what do you mean by that? Can I send a child to boarding and say that that person is a qualifying surviving spouse? The answer is yes. If you were the guardian and if your home address was given as a home address of the child in the school. So in that case, for the entire year, you have maintained a house which was a principal place of residence for the dependent child. Please remember this child. Now, okay, the definition of child in the US is very loose, guys. Okay, they don't just say it's your blood child. They will include your adopted child. It will also include your brother and sister. They're regarded as your children. The children of brothers and sisters are also regarded as children. Okay, so they're very lenient with the definition of child. And in the EA papers, they're not going to question you on the definition of child. Okay, just remember, we say brother. So child means your child, your adopted child, the child of spouse that you've married. So in the US, it's more common than in India to see people getting divorced and then getting remarried. And when you get remarried, then the spouse's earlier child can also become your child. Okay, and even for that child, you can claim a qualifying surviving spouse status. Now, there's something called a foster child. Anybody has any idea what's a foster child? So let's say there was a child who was at child abuse, who was facing child abuse from an abusive father. Let's say mother is not there, abusive father. So the state takes care of that child and gives him in foster care. And you can become a foster parent to a child like that. Okay, so those foster children are specifically excluded in the definition of qualifying surviving spouse. So this is something that I want you to understand because this is the only area where a foster child is excluded. Okay, so remember again what we're doing filing status. So on your return, you can file as single, married filing jointly, married filing separately, qualifying surviving spouse, and as a head of household. Single married is very clear, 31st December, single married filing separately clear, but we don't want. So we discourage. Qualifying surviving spouse, remember in the year of death, it is married filing jointly. 2 years subsequent to the year of death, you can have a qualifying surviving spouse status, provided you must have maintained a house which for the entire year was a principal place of residence for a child who is dependent on you. Child will include you, your child, your stepchild, your adopted child, but it will not include a foster child. Okay. Now, when I say maintaining a home, what do you mean by maintaining a home? We'll talk about it. But before that, let's talk about what is an HOH status. Okay. So the next status available is head of household. Who is the head of an household? Now, somebody who's an HOH cannot claim a single MFJ. So the others definitely will not be possible. Now, one thing is very clear. If you're a non-resident alien, I will not let you take advantage of an HOH status. So this status is not relevant for a non-resident alien. So who is the head of our household? Somebody who's either single or legally separated or in the process of getting legally separated. So this kind of a spouse is called abandoned spouse. Spouse who is married, but for the last 6 months of the tax year, the spouse has not been staying with the spouse. So we say, okay, you're in the process of getting legally separated. So 3 things, either if you're single or legally separated or an abandoned spouse, you have an option of claiming something called an HOH status, which is head of household. You can say that I am a head of an household. When, head of, okay, this is household, okay? When you're single, legally separated, abandoned spouse, and you're also maintaining your home or a household, which is the principal residence of somebody for more than half of the tax year. Who is the somebody? Somebody must live with us. Who is the somebody? The somebody may be a dependent child. So this is a concept that we're going to learn on Saturday. What is a dependent child? What's a dependent relative? But if it's a dependent child, that dependent child has to stay with you for more than half of the tax year. If it's a dependent father or a mother, the dependent father or mother need not stay with you. So what do you mean by that? So let's say I'm a single person. Okay, I'm a single person. I'm taking care of my mother. Okay, let's not say let's say X is a single person. Okay, so X is single, has a mother who has Alzheimer's at a very advanced stage, and because of that, the mother has to be put to a nursing home where there is a better care of taking where the provision of taking care of that person. So I am paying the entire cost of the nursing home. I am the person who's the guardian of that patient, and I am the person whose house is regarded as the house, which is the address for the parent who's in the nursing home. So we say, okay, just because that person is not staying with you and that person is your father or mother, can we say that you cannot take the advantage of a lower tax rate? We say no. Okay, if there is a dependent father or a mother who is staying in the nursing home, let's say. So what do we say? If it's a mother or a father, you don't have to stay with me. Even if I'm maintaining a house, which is your principal residence for more than half of the tax year, I would still qualify you as my dependent and I'll claim as an HOH status. Now remember, an HOH status cannot be claimed for a friend. So imagine if there's a person who goes to the US and that person has a very close friend. That friend also goes and stays with the person in the US. The person in the US is earning and the friend is studying, let's say. Now remember, in HOH status, even if you're maintaining a house for your friend, even if you're maintaining, paying for all his stay and everything, even in that case, you cannot claim an HOH status for that individual who's a friend. An HOH status has to be because of blood relationship. So only for a relative, but that relative has to stay with you for the entire year. That relative must have lived with you, okay, for more than half of the taxable year, actually. Okay, so this is more than half. It's not for the full year, guys. It is for more than half of the taxable year. So for the dependent child, must stay with you. For a relative, must stay with you. Dependent father or the mother need not stay with you, but you have to maintain a house which was your principal residence for more than half of the taxable year. We will do questions on this, don't worry. But as of now, understand 5 statuses and what is the provision for applying each of the status. So for a qualifying surviving spouse, for the entire year, you must have maintained a house. For a qualifying child who's staying with you, you're maintaining his house, and the spouse must have died in a year. So for 2 years subsequent to the date of death, provided you have not remarried, you can claim that person as your dependent. HOH, I have to maintain a principal house or a residence for a dependent child who has to stay with me, a relative who has to stay with me, but father or mother need not stay with me. And I must be either single or legally separated or an abandoned spouse. Only in that case can I claim an HOH status. Okay? So what do you mean by saying I'm talking so much about? So there are two terms, right? One is maintenance and another is support. Okay? By maintenance, I don't mean giving support. Okay, so I'm not talking about giving clothing, education, life insurance, vacation to the person. I'm saying I'm maintaining my house for you. So that means I'm paying the property tax, I'm paying the interest, I'm paying rent, electricity, upkeep, repair, all of this. I am maintaining the house for you. Okay. Okay. Now this is a very important concept, guys. Okay, because this is a concept that keeps on this underwent a change a couple of years back when Tax Cut and Jobs Act got introduced. Okay, so imagine there's spouse A and there's spouse B, and they had a child C, and now these spouses are separated. They are no longer together. The question is, And okay, now let us assume that A was a person who is earning more, and according to the divorce decree, A has to give child support. Okay, what do you mean by that? That means whatever is the cost incurred for sustaining C, that cost to some extent will be borne by the A. So the child's education, child stay, all of that is being met by A. So some amount is being given by child support. The question is, who will claim C as a dependent on their return? Will it be A because A is paying all the cost for this education and everything? Or will it be B because C is staying with B? Who will claim? Because you know that in this case, if neither A nor B remarries, both of them can claim an HOH status because they are single now, because they're legally separated. And at the same time, they're having a child who they are maintaining. So, who will be able to claim the child on their return? Now, earlier they used to say that, see, whoever is earning more, let that person claim the child on their return. But now they've changed it and they said, no, please see who has the custody of the child. Who is the person who is staying, who for with whom the child is staying. It doesn't matter who is providing the child support, who is taking the cost of upbringing of the child. So we say the custodial parent has a right to claim the child as a dependent on their return. Okay, but can that so? But let's say B is not working. B has no income. So can A come and request B and say that, see, you are supposed to basically claim C, but since you have no income, there's no benefit that you will get. Can I claim C on my return? And B says, okay, I don't have a problem. So what does B do? B files a paperwork and gives over the right to claim C as a dependent to A. So again, what we are doing, A, B are married, now separated, have a child. Law says that anybody who has custody of the child can claim the child as a dependent on their return. So in that case, what I did, I'm supposed to take C as a dependent on my return. But B is not working, there's no income. So A comes and approaches B and says, can I claim C and my dependent on my return? B says, okay, I don't have a problem. B relinquishes that right and gives that right to A. So now who is claiming the child as a dependent on their return? It is A. Can A now claim an status? The answer is no. Ed status is dependent on the child's maintenance of home. And who's doing that? It is by the custodial parent. So now I'm reading the C. A custodial parent, in my example B, who has released the right to claim the dependency exemption on the non-custodial parent. So I am not claiming C as a dependent on my return. You can claim C as a dependent on your return, which is A. By filing paperwork, which is Form 8332, may still qualify for HOS status. So I am not claiming C as a dependent on my return. But if I want, the HOS status can be claimed only by B and not by H, because technically A is not maintaining a house for C. So remember, even if I give up my right for dependency, I will still retain my right of claiming the HOS status. And conversely, if a parent who is a non-custodial parent, he or she can claim the dependency but still can't claim the HOH status for the child. Is this clear? Anybody, any questions? Is this clear? Is the concept clear till now? There are practical questions. Just wait. We will discuss it. 1 second. Naveen, for which one did you answer a no? Unmute. Hello? Naveen, are you there? For which question did you say no? Do you have any question that no, or do you have a problem in understanding? Then you please unmute and tell me which concept. Okay, my suggestion is let's take the practical questions. Once we understand the questions, it will be easier to go back to this. Okay, 1 second. Okay, just wait on. Okay, okay. First, okay, let me first take you through some questions. Okay, then I'll go back to 1 or 2 slides back. Okay, first question, go slow and then answer the question. Jerry, so the call of the question is what is the filing status which will give the lowest tax rate to Jerry? Okay, Jerry is a 37 years old person. His wife died during the current year and he has not remarried. His deceased wife had no income. So there is Jerry, there is Jerry's wife. Jerry's wife is no more. Jerry has 2 minor children. So 2 children, child 1 and child 2, who's living with him. Jerry paid all of the costs for keeping up his home for the tax year and he has paid for all of the support of his wife and of these children. What will be the filing status for Jerry in the current year? Can anybody tell me? What will be the filing status for Jerry in the current year? So I have 5 statuses. I have single, I have married filing jointly, I have married filing separately, I have qualifying surviving spouse, and I have head of household. So in the year of death, one second. Yeah. So remember, in the year of death, we are going to file a married filing jointly return. But the same question, if I would have told you next year and the year thereafter, next year and the year. So in this question, in the year of death, we are not going to be swayed by the data that is given to us. In the year of, no, Sakshi, this is the year of death, right? In the year of death, please understand, we don't prorate death. If the spouse would not have died, Jerry would have still went ahead and filed a married filing jointly return. In the year of death, it will be married filing jointly. 2 years after the year of death, did you remarry? The answer is no. Did you have children or a child whom you are supporting? The answer is yes. If it is for the entire year that you're providing your house, which is the principal place of residence for the child, then you can claim qualified surviving spouse status and you can use the joint married filing jointly tax rates. Okay. Naveen, are you clear with this? Is this clear? Naveen, I can't hear you. Is this clear? Sakshi, is this clear? Sakshi, is this clear? Okay. Yeah. So follow me. So we have understood qualifying surviving spouse. We have understood married filing jointly. Okay. Now let's go at this question. Who would not be a qualifying person for purposes of filing as head of household? So who is a head of an household? Somebody who's single, married, file legally separated. So I'm single, but I'm taking care of a dependent child who's staying with me for more than half of the tax year. I'm taking care of a dependent parent or father or a mother, but that person need not stay with me for more than half of the year. But I should be maintaining a house which should be his or her principal residence for more than half of the year. It can be a dependent relative, but that relative has to stay with me for more than half of the tax year. Only then can I be qualified as head of household. Okay? Only then can I be qualified as head of household. So they are saying, who is a person who would not be a qualifying person for purposes of filing as head of household in a tax year? Your mother, whom you can claim as a dependent. So your mother can be claimed as a dependent in my return, right? Your mother can be claimed as a dependent in my return. Okay? One second. Yeah. Your adopted child who lives with you is married and can be claimed as your dependent. So if I have my child who's living with me and I'm claiming the child as a dependent, I can claim that person as a HOH status also. Your foster child who lived with you all year and is your dependent. So now remember, only qualifying surviving spouse excludes the foster child. Otherwise, everywhere, every child is included. Your aunt related to you by blood, but she does not live with you, but is your dependent. So what do you mean by saying is your dependent, but is not staying with you? So there is an aunt for whom I'm paying money so that that person can survive. But that aunt is not staying with me. So this is a relation. But for that relation, for you to claim an HOH status, that person should have stayed with you for more than half of the tax year. Since that's not happening here, since that person is not staying with you for more than half of the tax year, you cannot claim that person. And for that person, you cannot take the HOH status. Naveen, is this clear? One second. Naveen, unmute yourself. Is this clear? So single, married filing jointly. Clear. Married filing separately. Clear. Qualifying surviving spouse, not in the year of death, but 2 years thereafter, provided you have also maintained a house for the entire year for a qualifying child who's dependent on you. What is HOH? You're single. So basically you're alone and you're taking care of people. Why are you not able to unmute? Now unmute. Then I suggest you log off and then, yeah. Naveen, can you hear? So Naveen, I think there's something wrong in your speaker because I can see that the speaker option is unchecked. So now if you're not able to speak, then my suggestion is log off and then relog in. Yeah, so please log off and relog in. There's something wrong at your end, okay? Okay, now go slow and understand this question. What is proper filing status? What is proper filing status? M and E were married, but they got divorced on 1st June of the current year. That means 1st of June, they're legally separated. Their one minor child lived with E the entire year. So there is a child who is minor and that person is staying with you for the entire year. Worked all year and provided more than half the cost of keeping up the home for herself and her minor child. Signed Form 8332. So basically, E becomes a custodial parent and M becomes a non-custodial parent. The law says whoever is the custodial parent can claim the child as a dependent on their return and can also claim the HOH status. Now see, signed a form in order to release the claim for exemption of the child. That means now the child is being claimed as a dependent on M's return, allowing man to claim their child as a dependent on his separately filed return. What is E's proper filing status? What could be the filing status for E? What will be the filing status? No. See, what is the HOH status says? HOH says, what is the requirement for HOH, guys? It is not support. It is staying with you. The child is still staying with you for more than half of the tax year. The child is still staying with E for more than half of the tax year. So E can now claim an OH status. E can claim an HOH. Please remember, guys, the HOH status cannot be claimed by the non-custodial parent. Even though the dependency can be claimed by M, but the HOH status would still go to E because the dependency says that the child must have maintained the home for the dependent child for more than half of the tax year. So in this case, remember this is an exception to the rule that the child has to be dependent on you. In this case, even though the child is not dependent, because you're not claiming the child as a dependent, but since you're maintaining the house, which for more than half of the tax year is the principal place of residence for the dependent child, for the child, you can still claim the HOH status. This is what was meant by the provision that I had stated earlier. Is this clear? Please remember, just because the child is being claimed as a dependent in M's return, M will not be able to claim the HOH status. It will only be E who can claim the HOH status. Sakshi, unmute yourself. What did you not understand?
Hello, ma'am.
Yeah,
It
yeah.
just got clear to me right now. You just said like just because Matt is claiming all the expenses doesn't mean he will get the HOH status because he is not providing the home. Elena
Yes.
can get the HOH status even though she is not claiming all the
Yes.
expenses because she is providing the home.
So the provision says that you should have maintained a home which must be the principal residence of the child for more than half of the tax year. Is that clear? So that condition is being
Yes,
met
ma'am.
by, so only E can claim the HOH status, not M. Okay? Naveen, are you able to unmute? Because I can see that your icon says it's unmuted, but I cannot hear you. Do you want me to wait for 2-3 minutes? Please go out and then relog in. Okay, 1 second. I want to take you. Okay, now look at these tax slabs. Naveen, if you are able to unmute, let me know what is your question. Okay? Hello? No, I can still not hear you. I think there's something wrong with the speaker that you have. I can still not hear you. Please write your question in the chat panel. Let's see if I can answer there. Okay, now look at the tax slab, guys. Remember, MFS would be half of MFJ's and HOH is a separate return and qualifying surviving spouse will use the married filing joint rates for 2 years after the year of death in case if there's a dependent child for whom you have maintained principal house for the entire tax year. If you look at the tax slabs, okay, you will see that very soon for single filers, the tax rates would increase from 10 to 12%. But if you look at it, the incidence will be the lowest for married filing jointly returns. So ideally, you will save most taxes by filing as married filing jointly return because the highest tax slab will be hit at the end, and at the same time within there is more gradation for lower tax rates than the others. Single are the worst actually. HOH is somewhere between single and married filing jointly is HOH. Okay, I've already spoken about abundant spouse. So even if you are in the process of legal separation and you're not staying with the spouse for at least 6 months towards the close of the tax year, and if you're supporting somebody, you can still go and claim the HOH status. What's a non-resident alien spouse exception? See, when a married taxpayer spouse is a non-resident alien, at any time during the year, and the election of choosing as file as is not made, so that person is still a non-resident alien, then that person, see, then the taxpayer is considered unmarried. So basically, if you're married, you remember the provision that we spent left for non-resident alien, the spouse is getting married, getting into the US. Now, if you are still going and claiming a non-resident status, that means you are not filing a married filing jointly return. See, the person is still claiming, and so in this case, even if you are married but you are a non-resident alien, then you cannot go and file a married filing jointly status. But the person who is now in the US, this person can still go and claim an HOH status because you're married but you're not claiming the because your spouse is a non-resident alien. In that case, you can go ahead and you can file as an HOH. Is this clear to everybody? Okay, so remember what we did so far. We've spoken about who is supposed to pay tax on what income in the US. We have spoken about the filing statuses. There are 5 filing statuses, but only 3 tax rates: single, married filing jointly, married filing separately, qualifying surviving spouse, and head of household status. Single and married filing separately, the difference is on 31st of December, 12 o'clock. Are you married or are you single? If you're married, it's married filing joint. If you're married but divorced, then also it's single. If you're married but towards the last 6 months of the tax year, you're saying separately, then again you can claim you can claim a married filing jointly status if the 2 spouses wish to do so. Qualifying surviving spouse is never applicable in the year of death. 2 years post the year of death. So in the year of death, you will still go ahead and file a married filing jointly couple if you've not remarried. But 2 years after the year of death, if you have a child, dependent child whom you're supporting and for whom you're providing the principal place of residence for the entire tax year, you can claim the qualifying surviving spouse status and you can use the married filing jointly rates that is applicable. If you are single, legally separated, or an abandoned spouse, and if you're maintaining a house which is a principal place of residence for a child who's staying with you for more than half of the tax year, or a relative, please remember it has to be blood relative, not friends, who's going to be staying with you for more than half of the tax year, or a dependent father or a mother, but that person need not stay with you. Remember, the only provision is the dependent parent need not stay with you. Then you can claim an HOH status. That's it. Is this provision clear? Anybody? Any questions? Anybody? Any questions? Naveen, I don't know. I'm still not able to hear you. Whatever you're speaking, I cannot hear you. Okay, so if you can write your question in the chat panel, I think I will be able to answer your question. Otherwise, I would move it. 1 second. HOH is not clear. Okay, HOH. Okay. Follow me. Do you have a question? You wrote no to something. Okay, no, not to have any questions, is it? Okay, HOH is what, Naveen? HOH is I am single, but I'm maintaining somebody. Now, that somebody can be a child. See, understand that for QSS, if I want to take a benefit, I have to prove that the person died. My spouse died, right? HOH means I am single or I'm not filing with anybody. But at the same time, I'm taking the burden of a relative or a child or my parents on me. And in that case, how do I say that? I say your house should be the principal place of residence of the child for more than half of the tax year. And that child must be dependent on you. And the child must have lived with you for more than half of the tax year. Even if it's a relative, it's the same thing. But for a dependent father or a mother, that person need not stay with you. Why? Because if that person is in a nursing home, but that person is being supported by you and your house is the principal place of residence, apart from the fact that that person is a nursing home, you can still claim the lower tax rates by filing an HOH status. Is this clear or no? Then in that case, if there's any specific query, then you let me know. Okay? And remember the custodial versus non-custodial parent. It's only the custodial parent who can claim the HOH status, never the non-custodial parent. Even if the dependency is being claimed by the non-custodial parent, but the HOH status can only be claimed by the custodial parent. Okay, so that is as far as filing status is concerned. Okay, now I have a question and I want you guys to think and answer this question to me. A and B married, A dies, B remarries. What will be A's filing status. So you will see in the US, A and B are married. A dies. B marries C. B will definitely file a married filing jointly return. Now, A, you will see in the year of death, there will be a final 1040 that will be filed for A by the estate of A or by the beneficiaries of A. What will be the filing status for A in his last return? Can anybody tell me? What will be the filing status? Okay, yes. This will be very good, huh? By the way, this will be, see, remember, this cannot be bad. So, had B not remarried, A would have been married filing jointly because A and B would have, because B would have filed a married filing jointly return with A in it. Now, this problem is no. So, okay, look at this. In this situation, why will A file as single? Because A was married at the time when A died. A and B were married at the time when A died, right? A and B were married at the time when died. So this is a unique scenario where the IRS allows or mandates A to file a married filing separately return. This will be married filing separately return because you were married at the time when you died, right? So you cannot be claiming as single because you were married. Naveen, is this clear? At the time when A died, A was married, right? So you would have been allowed to file a married filing jointly return. But now since B had remarried, you cannot file a MFJ. So there would be a married filing separately returned that would be filed for A who is no more in his last return. Okay. So we completed the no tax rates are not same in married filing separately and single. See, if you look at the tax rates here, married filing separately will be half of married filing jointly, and single is the highest tax slab. So it will not be the same. It's different for both of them. Okay. One last topic before we break the day. It's an easy topic. It talks about who is supposed to file returns in the US. Okay. So you will see that there's a big amount called standard deduction, which we are going to read at a later stage. I think for the year 2024, this amount is 14,600. Okay, I'll have to check this, but it's an indexed figure that keeps changing every year. If you're earning more than the basic amount that I allow you as a deduction, then you have to pay taxes. At least you have to file return, even if the tax incidence becomes nil. Second, now, this is a big thing in the US because there's a big culture of being self employed in the US. So, if you are earning from self employment and that figure crosses 400, even then you will have to file your own return. And third, if you have a dependent and that dependent is making some money and that money is more than the standard deduction amount, or okay, now this is something that we are going to learn a little bit more tomorrow. But you will see that, in India, there's this concept of clubbing of income. What is clubbing? Parents, if they want to siphon off their passive money, that means the money like investments, interest, bank deposits, and if I put it in my child's name, under the impression that I am the higher tax paying bracket, I'll push it to the child's income will be nil, so I will not pay tax on it. So Indian Income Tax Authority says you have to club that income in the parent's income and pay tax on it. In the US, what they tell you is there's something called kiddie tax. What is kiddie tax? Now, assume that there's a couple who are married. They have a 13 or a 12-year-old child, and that child is, let's say, doing newspaper route and getting some money from there. That is earned income, right? Now, in this case, or let's say, okay, not paper route. Imagine the child is working as an intern and she is getting money from her employer. But when the employer is paying her money, employer is deducting tax at source. And now when she is getting the money, she's getting it after the tax deduction. So this dependent, now see, you are providing for the studies, education, house, everything is yours for the child, right? Only for summer period, she has intern. So we say, okay, there is an earned income of the spouse, of the dependent child. And that child will also be filing her own return to claim the tax refund, right? Because you've already deducted my tax and I'm not supposed to be paying any taxes. So we say that whenever there is a child or a dependent who's staying with you and whose support you are providing, and that person is making money which is more than the standard deduction, then also that dependent has to file their own return. Or if the dependent is having a lot of passive income. Now, what do you mean by a lot of passive income? Now, we don't want that the parent must siphon off all the unearned income. That means all passive income. and put it in the dependent's name, let's say the child's name. In this case, in the US, there are two options. First option is the parent includes that passive money and pay tax on it at the highest tax slab. The next option is the child can file their own return, but for the portion which represents passive money, the child can be asked to pay tax at the highest marginal tax rate of the parent who is earning highest. And that tax is called kiddie tax. We will do a question on this practically tomorrow to understand what is kiddie tax and how it's applicable. For the time being, just remember if the child is having a lot of passive income, interest from investments, interest from deposit, dividends from shares, capital gains, all of this is passive money. So if the child is earning a lot of passive money, how do you say a lot of if it's more than $1,300? Or if the child is earning income at the total which exceeds the standard deduction, then also there will be a separate return that needs to be filed. And please remember that since I don't want anybody to file a married filing separately return, I will keep the criteria as $5. The moment your income increases, goes more than $5, if you're a married filing separately couple, you will have to file the tax rate. You have to file it 1040. Three scenarios when it's required of you to file 1040, when you're earning more than the standard deduction, when you're earning from self-employment and that figure is more than or equal to $400, and if you are a dependent and your gross income increases standard deduction, or you have a lot of passive income which exceeds $1,300. So this is as far as the who's supposed to file the 1040 in the US. This is the answer to that question. What is the due date of filing that return? Okay, they ask you, are you residing in the US? General rule, if you've not filed any extension, if you've not filed a request with the IRS that please extend my time for filing the return, the general rule is for a calendar year end, which is Jan to December, next year by 15th April, you'll have to file your income tax return. Please remember that this is the target for filing return and for paying taxes. You have to pay all the taxes for the amount that you would have earned till 31st of December, and 15th April is the target by which you have to pay you have to file the return. Now, in case if the filing extension is sought, now this is an automatic extension, which means the moment I file a form, the extension becomes automatic. Now, IRS does not have to approve. If that extension is sought, then the due date becomes 15th of October. But please remember, this extension is only for filing the return, not for paying taxes. The due date for paying all the taxes in order to avoid liability is 15th April. It is not 15th October. Even if you get extension for filing the return, you will still have to pay all your taxes by the due date, which is 15th April. So what is the due date for Form 1040? It is 15th April of the following year. We are following the end of the calendar year. But if you have sought an extension for another 6 months, the due date becomes 15th October. But even if you've got an extension, you have to freeze and pay all your taxes by 15th April because the extension is for filing return, not for paying taxes. Okay. But if you're not a resident, okay, and you're filing 1040 NR, which is 1040 non-residence return, then if you do not have any tax deducted at source, okay, if you do not have any tax deducted at source, then the due date becomes 15th June. Else, if there is a TDS, so let's say if I am going in the US and working for 3 months and I'm working as an intern somewhere where I'm getting paid and that person is deducting tax at source and giving me the money, then the due date becomes 15th April. But if I'm going there and I'm freelancing and there's nobody who's deducting any tax at source for me, then the due date for me to file my return becomes 15th June, not 15th April. So this is the exception that I want you to understand. So general rule, if I'm a resident and my due date becomes 15th April, if the extension is sought, it becomes 15th October. The only exception is if I'm a non-resident and there has been no taxes withheld. In that case, my due date becomes 15th June. One more question, which is, now this is an exception. Now see guys, these are now very finer details. So if you get a question on this, then you need to know this provision. Now what I say is, if you're a US citizen or a resident who is on the military or naval duty and you're supposed to leave the US, so the calendar year end was 1st January to 31st of December. but you were on a military duty, because of which you could not file your return on April 15th. Then in that case, I'll give you an automatic 2 months extension, April, May to June. So by June 15th, you will have to file your return if you are not in town because of some military duty and you have to leave the US. So in that case, automatically I'll give you a 2 months extension and you don't have to file the form for requesting me to extend. It's an automatic extension. You get a 2 months time to file your tax return. Okay. The due date, somebody who's died during the year, the due date does not become 3.5 months after the year of death. It is still remaining as 15th of April. So let's say somebody dies in April, you will wait for the entire year to end. The due date of the return is on 15th April of the next year, irrespective of when is the date of death. This I've already said, that when you get an extension of 6 months, it's only for filing your return, not for paying of taxes. Employers are required to keep records of all the employment taxes for 4 years. And you need to have something called an employer identification number if there's any employee for whom you're deducting taxes. Okay. So if my TDS has been deducted, I need to provide the employer identification number, which must be issued to the employer. Please understand that whenever you file a return, if it's an MFJ, then you and your spouse. If it's a single return, then you alone, or the TRP who's helping you to file your return. There is a statement that says, all of this, the knowledge and the data which is contained, to the best of my knowledge, I know it is true. So when you are checking that box and then you're filing your return, then you are submitting something to called perjury. That means in case if later on it is discovered that there were errors in the return that you should have known, in that case, you would be charged with felony and there's a big amount of penalty that you would be imposed. So please remember that when you file your return, you must sign. And when you sign, you are declaring to the US that you have not committed felony. So in case if later on it is discovered that you've deliberately hidden certain data or did something which was wrong, in that case you would be charged with felony, which is like a big offense. It remains on your books forever. Also, when you're filing your returns, there's something called IPPIN, which is Identity Protection Personal Identification Number. Now, why was this number used? See, SSN is a number which you have to give to a number of places. So this is like a second layer. It should not happen that somebody else uses your SSN number and gets refund in his or her name. So in order to prevent something called identity theft, because IRS wants to protect your identity, not only the SSN number, but the IP pin also can be provided. And if there is a mismatch, then IRS will not process the refund against your name in somebody else's account. So there's another number that can be given to you, which is IP pin. I think just two more questions before we end today. First question, nothing of the filing requirement, okay? Which of the following is true regarding the filing of the form 4, which is extension? So when you're filing 4868 to request the IRS to extend the filing of the return by 6 months, which of the following is true? Okay, give me the answer for the 8th question in the chat panel. Please write 8 and then give me the answer. Filing the form provides an automatic, now this is not 2 month, it must be a 6-month extension. So I know this is not true. Any US citizen who's out of the country on April 15th is allowed an automatic 6-month extension. Now this is also wrong because it has to be US citizen, resident, military duty, and the extension is for 2 months. It is not for 6 months. Interest is charged on tax not paid by the due date of the return, even if extension is obtained. Now, this is something that I'm 100% sure is true. Because even if I get an extension, it is an extension to taxes, to file return, not to pay taxes. Electronic filing cannot be used. This is wrong. Everything in the US is electronic. Hence, it's a very good investment for you guys to invest in knowing this, because you can file returns from India also. So the answer for 8 becomes C. Last question for the day, okay? What is H's income tax return? When is H's income tax return due if she does not apply for an extension of time to file, ignoring weekends and holidays? During year 3, H was a non-resident alien engaged in a business in the United States. All of her income was from self-employment. That means, so the moment you hear non-resident alien, in your mind, the buzzer that should beep is TDS. So if there is no TDS, then the due date becomes 15th June. So this is a question that is directly testing that concept. When there is no TDS, now see, what does the rule say? The rule says if you're a non-resident alien and there is a TDS deducted, then the due date is 15th April. But if you're a non-resident alien and there is no TDS that is deducted against your name, then the due date becomes 15th of June. So the answer becomes C. Last question, guys, okay? Then we'll break for the day. This is that provision that talks about the person going on military duty and not being in the US on 15th of April. So you automatically get 2 months extension, right? So even if I don't look at it, I know this is wrong, okay? I know this does not stand a chance. So the choice is between A and C, and I know the choice looks like A, but I will go through this again. T is a calendar year taxpayer, was assigned a post of duty on USS Eisenhower. The ship went on a 6-month cruise of the Mediterranean Sea, leaving 15th February. That means next year, this person is not in the town at the time when the return is supposed to be filed on 15th of April. Tim Altman did not file the, so you're not required to file an extension. You get an automatic 2-month extension. Altman is automatically granted an extension of time to file his year 3 income tax return and pay any tax due until what? Until 15th of June. You get an automatic, no, cannot be 10C. It's 15th of June. Automatic 2-month extension. Automatic 2-month extension. So this is a provision that we just did, right? This is a provision. See, a US citizen or a resident who is on military or naval duty outside the US or PUCO on April 15th is given an automatic 2-month extension without the requirement to file Form 4A. So the answer becomes A, which is 15th of June. So we did 3 concepts today, guys. We did nationality, we did filing status, we did filing requirement.